Welcome back and welcome to Investment 360. Still with me is Viv Govender. We're joined in the studio by Henk Potts, who's Director of Global Research and Investments at Barclays Wealth. Hi, Henk.
Good evening.
Let's start with the US. I happened to see on the way here today in the newspaper, new car sales in the US, best in 4 years. Often seen as an indication of a recovery because you don't have to buy a new car. You don't have to buy a car.
It's true. And it's part of actually a trend of data that's been getting an awful lot better in the United States. First half of 2011, absolute disaster. Consumer confidence, very poor indeed. The labour market continuing to struggle from a lack of employment opportunities being generated. But I think as the year went on, things got an awful lot better. Remember, the US economy grew by 3% in the fourth quarter of last year. And I think we've taken some of that momentum into this year. And particularly the idea of job creation. 227,000 jobs created last month in the United States. Unemployment down to a 3-year low. Absolutely vital for the US economy. Consumer consumption accounts for 71%. If the consumer spending is good news for the US economy, but also good news for the global economy. The US consumer equates to 14% of all global purchases.
Good news for Barack Obama too, if it carries on for the election in November, Viv?
Yes, I'm just speaking on that jobs number. I did see a report by Bank of America today that mentioned that there were certain caveats with regard to that the 200,000 plus number we saw last week. Firstly, it was the mild weather that occurred, and apparently mild weather makes those jobs numbers look better than they actually are.
In terms of construction, you tend to see a stronger numbing come through. So there are some seasonal effects there, but this is part of a much stronger trend that's been coming through. If you look over the past 3 months, more than 200,000 jobs created each of those months, much better than we've seen before. Now some would say it's a coincidence, it's a presidential year, there's a lot of stimulus been put into creating these jobs. That may well be the case. It may be a little bit under the table, but who cares, because quite frankly it's doing the job. US authorities, I think, have been very aggressive in some of the measures that they've taken. Interest rates historically low levels and will remain so until 2014.
And they've said they will.
Stimulus packages been put in place, extension to those Bush tax cuts putting through. So there's a lot to be awfully positive about in the United States. Fed's balance sheet, 230% bigger today than it was at the start of this crisis. They've been aggressive. We're starting to see them rewarded
for that. And of course it becomes a virtuous circle because that improves confidence and people start feeling better and then you get more investment and so on. Now,
absolutely.
How does this compare with Europe? Because they said the US is going one way, Europe's going the other. Who's right? Does this mean the US was right and the Europeans are wrong?
The US could afford to take a much longer and be more aggressive in terms of the amount of money that they spent. The haphazard nature, this half-hearted attempt to deal with the European sovereign debt crisis has simply exacerbated the problem. It's created greater uncertainty. It increased the risk of contagion. But over the past 18 months, I think we have seen officials starting to implement solutions that have been easing the crisis. In fact, the pace of that progression has been picking up over the course of the past few months. We've seen indebted European countries introduce austerity measures in a transparent and tangible fashion. Even our friends in Greece now appreciate they've got to pay some tax. So we really have moved on a long way, it has to be said. The bailout mechanisms will also be scaled up. But the real game changer is the European Central Bank, Super Mario Draghi, taking over from a rather conservative Jean-Claude Trichet. €1 trillion being pumped into the European financial system. That's helped with liquidity, but it's also taken some of that pressure out of peripheral bond yields.
You did mention Greece, obviously, but I mean, many now say even those that have the new Greek bonds are probably going to face another default going down the road. Even with the new rates that they've gotten, even with the default, etc., the partial default they've put through, they still will not be able to repay that debt. And yet we're also seeing Portuguese interest rates remaining well above 13% at the moment. That's still quite a negative, I think, outlook for those two countries.
And to put it another way, we keep hearing that the Greek thing is fixed and that there's a solution, and then we hear it's not.
It's not fixed. Listen, they've signed up for their second bailout. Hopefully they'll implement those austerity measures they've planned to, so the privatisation programmes, the cutting government spending, the increase in taxes. It's good. But listen, it doesn't solve the problem. There's two other fundamental issues that we need to hear about. And the problem's way beyond Greece. We can focus on Greece, and yes, it's been, the problem child, but there's a much bigger issues within the European family. And I think we still need to hear a lot more about the road to fiscal union. We need to know the framework in which new fiscal rules will be put in place, who's going to monitor them and how. Perhaps more importantly, what penalties will be put in place for countries that fall foul of that. And something we haven't heard anything about, and it's got to be part of the solution, is how to generate growth within the Eurozone, how to stimulate those job opportunities. And when you come back to Greece, you're absolutely right. They can implement this, but at some point, the economies have got to stabilise, they've got to become more competitive, and that's going to be the key to the solution. When they signed off on Greece, everyone hoped it was the end of the European sovereign debt crisis. Quite frankly, this will take a decade to solve.
As you mentioned Greece, I mean, I was seeing numbers that were quite scary. Some people were saying that by the end of, I think, the next year, we'd have seen the Greek economy shrink by 25% from where they were before the crisis. This is worse than the US had during the Great Depression. At the same time, you mentioned the penalties we're talking about. Spain has a new budget that's not going to meet them. Are they going to impose penalties on Spain?
Well, the new Spanish leader will tell you, listen, I'm a technocrat, I've taken over from the politicians, it's going to take me a bit of time. I think they will work hard in Spain to try and improve the conditions there, as we've seen in the likes of Ireland, for example. So I think you can say Greece has got specific issues and it's going to take decades for them to resolve that. Their living standards has been absolutely obliterated, but we can say they're better off within the Eurozone with the help of Germany and France writing some big checks. It's better than them leaving, devaluing and trying to become competitive on their own.
But isn't that the major gamble here? Because some are saying if the Greeks do leave and if they do perform in Argentina, in which basically they have a bad year or two and then have a spectacular growth, won't that give an incentive for every other massively indebted country, the Portuguese, the Italians, etc., to say maybe we want to leave as well?
It would be a tempting thing to do.
It would be a tempting thing to do, and if that scenario played out, they've probably done the right thing. But I think it's very unlikely that that good scenario will play out for Greece. The reality of a default or them leaving the Eurozone would mean there'd be a run on their banks, private savings would be absolutely obliterated, they would have to import a huge amount of inflation, they're big buyers of energy, living standards would be obliterated, as I say, for decades. And the positive side, well, they become more competitive. Well, you give me the list of Greek exporters out there that's going to benefit from this wonderfully competitive environment. The tourist industry, maybe. Beyond that, there's not a big list. So listen, it's better for the Eurozone, it's better for Greece if they stay within it, and also keep the project going.
Let's move to equities generally and risk and reward there. You've said that there are opportunities out there, and of course, whenever things are bad, people cannot imagine they'll ever be good and vice versa. But you're saying now's the time.
I talk to clients all the time, and I ask them, when should you buy into stock markets? When they're weak or cheap, or strong and expensive? And they all put up their hands, and you know what they say? I buy stock markets when they're weak and cheap. But the truth is, none of them do. The truth is, they buy it when their friends are doing well, when stock markets are performing well. But it's too late then, because you've missed the opportunities. We're in a good position at the moment, where the headlines are still negative, but starting to improve. So while momentum and sentiment, I think, drove markets last year, we're returning back to fundamentals this year. And the fundamentals very strong indeed. Corporate profitability exploding. If you look at the global quoted corporate sector, profitability grew by 30% in 2010, 10% last year, another 10 to 15% this year. Balance sheets incredibly healthy. More cash on US corporate balance sheets today than has ever been the case. Given the underperformance in terms of equities, that explosive profitability, valuations look very attractive. It's an opportunity.
You say buy when it's cheap and weak, etc. But after the 20+% rally we've seen in the last few months, is it still the right time to get in? Is it still cheap?
Valuations still give you some momentum from here. I think that's fair to say. Yes, we've seen a good rally and clients are saying, have we missed it? I don't think that's the case. Time is still your friend in stock markets. The longer you keep your money in stock markets, the better chance of outperformance.
We'll have to stop there, Viv. Fascinating discussion, which we can go on all night with. That was Henk Potts, Director of Global Research and Investments at Barclays Wealth.